Students, so in today's lecture I will be talking about the international financial markets. This is unit 3 and this is the first video lecture, and I will be continuing the further topics in the video lecture itself. Now before I move to the international financial markets, let's see what is a financial market. Now you know that borrowers require money to fund their operations, while lenders have a surplus of funds and they want to invest it somewhere. So this market, or a financial market, is the one that facilitates the transfer of funds from the lenders to the borrowers. So this market acts as a mediator between the borrowers and lenders. It provides those who want funds, and it gives an options to those who have a surplus of funds to invest their money. Now there are different types of institutions that use different types of instruments to transfer this money from one person to another person. Now when this transfer is happening within the national boundaries, if it is happening within the boundaries of a country, then it is called a domestic financial market. Okay, but if it moves to the, or it moves beyond the national boundaries, then it is called an international financial market. Okay, so when the transfer of funds between parties is confined within the national borders, it is called a domestic financial market. But when the funds cross the national borders and the transfer is between the parties which are residing in different countries, then it is called an international financial market. Now, why do you think firms or individuals go to the international financial markets from the domestic financial markets? Now, there are certain reasons responsible for this development of the international financial market, because of which there is a movement of investors and borrowers from the domestic financial market. The first reason is there is a difference in the interest rates. Now, how does this play a role? Now, suppose there are two countries, for example, say India and say China. The rate of interest currently in India is suppose 8% and in China it is 9%. So if there is a borrower who wants to borrow money, then it is beneficial for him to borrow it in the Indian market because the rate of interest is less. However, if there is a lender, then he should go to the Chinese market because there the rate of interest is higher. So borrowers would like to borrow from countries where the interest rate is lower compared to the domestic market, whereas investors would like to invest their funds in countries where the interest rate is higher. This is the first reason why the international financial market is important, and it has been created from the domestic financial market. The second reason why firms go to the international financial market is it provides a way for international diversification. Now, what is diversification? Diversification is a way of allocating the resources to different areas so that the risks are reduced. So different countries have different economic conditions and resources, which helps the investors to reduce the risk associated with a single country. For example, if I invest all my money in the Indian economy, and if the economy falls in the near future, then my entire investment is gone. However, if I have invested my money in different countries, then even if some part of my investment goes down because of fall in the Indian market, at least a part of it will be safe because of the investment in the international market or some other market. Okay. The third reason is economic growth prospects. Now, different countries have a different pace of growth. For example, the developed countries' growth rate is less as compared to the developing countries. The developing countries have a greater potential for growth. So, these conditions attract the investors and creditors to such economies where the economic growth rate is expected to be higher than the developed countries. The fourth major reason for going to the international financial market is the fluctuations in the exchange rate. Now, the exchange rate is the rate at which the currencies between two countries can be exchanged, and this exchange rate keeps on changing in the short run and the long run. So, if a currency is expected to appreciate in the future, then it is advantageous for an investor to purchase securities in that currency, because in future the currency will appreciate and will give a greater return. So this appreciation and depreciation of currencies plays a very important role in the investment returns of an investor. So international financial market is the market that exists between the countries and facilitates the transfer of funds between two different nations. And this market is important because it facilitates or it helps through difference in interest rates, through international diversification, by providing economic growth prospects, and because of exchange rate fluctuations. Now, what are the various sources of international funds, or from where can we get the international funds? So there are various institutions that fund or provide the international fund. These institutions are various multi-developmental agencies. So you would have heard of the International Monetary Fund or the World Bank. So all these are institutions that are providers of funds in the international market. Secondly, the governments also borrow and lend money to each other. So in the international financial market, governments are also a major source of funds. The third is international banks. So there are various banks like the Asian Development Bank, the African Development Bank, and various other regional banks which are acting as a major source of funds for various reasons. Now, the fourth is the securities market. There is an international securities market which is also a major provider of fund for the international market. Now, let's see how is the international financial market segmented, or what are the various segments of the international financial market. The international financial market can be broadly classified into 5 categories. The first is an international bond market. Now, what is a bond? A bond is a financial instrument which is issued by corporations and governments who are in need of money. So they will give the bond to the bondholder, and in return they will take money. The bondholder at the end of the maturity period of the bond will receive the principal back, and also he may receive coupon payments in between. So in the international bond market, international bonds are bought and sold. The companies may raise the long-term funds in foreign currency through issue of international bonds. There are two popular types of bonds, like foreign bonds and euro bonds, and we will be talking about the international bond market in detail later. So this is the first segment of the international financial market, which is the international bond market, wherein companies who require long-term funds or governments which require long-term funds can issue bonds in foreign currency and raise funds. The second is an international equity market. So just like the domestic equity market, a multinational company can raise funds from different countries by issuing shares in those countries. For example, if Indian company wants to issue get money in form of USD, then it can issue equity in the US market, and the shares will be listed on the stock exchange of the US. Okay. The third segment is the international money market. Now, money market is the part of the financial market where short-term borrowing and lending happens generally for less than 1 year. So, if company or government requires funds for less than 1 year, then they can go to the international money market. And there are various instruments of the international money market, like a commercial paper or a certificate of deposit or a treasury bill, through which the money can be raised in the money market. All of these instruments are of short-term duration. The fourth is an international credit market. Now, this is the market where the medium and long-term funds are exchanged between the suppliers and the borrowers of the funds. And the last segment of a international financial market is a foreign exchange market. Now, what is a foreign exchange market? It is the market in which the sale and purchase of foreign currencies happen. If someone wants to buy foreign currency, then they have to go to the foreign exchange market, and whatever the current rate of exchange is, they have to pay the rate of exchange and they can get the currency. So this is all about the introduction to the international financial market, the reasons why international financial market came into existence and became popular, the various sources of international funds, and the various segments of the international financial market. So in the next lecture, I will be telling you about the international money market and the international credit market in detail. Thank you.